The dream for many property investors is to reach a point where your portfolio is truly passive. But many investors out there will tell you that this is absolutely impossible. Well, I'm here to tell you that maybe this might not necessarily be correct. There is a strategy out there which many people are talking about at the moment, which could help make your portfolio as passive as possible. This, of course, is the social housing property strategy. In this video, I'm going to run through exactly what this strategy is and how you could potentially make it work for you. Hi guys, welcome back to the channel. It's Sam here. Today we're going to be talking all about social housing and how property investors can take advantage of these kinds of leases to make their portfolios as passive as possible. Before we get into it, if I can ask a massive favor, if you haven't already, please subscribe to the channel. I'm trying to get to 5,000 by the end of the year, which is a bit of a tall order, and I need your help doing so. There's over 200 videos available now on the channel, and I am releasing videos every week. So don't just hit the subscribe button. Also tap on the notification bell because you will be alerted then when every single new video is uploaded. Let's get back into it. Right guys, so social housing is a bit of a buzzword in the property world at the moment. So let's quickly, before we go into the nitty gritty, delve into exactly what this strategy is. The social housing property strategy is essentially taking a relatively standard property and renting it to a social housing provider. So this might be a company or charity or local authority will use that property to house people that really need it. This could range from asylum seekers, people that are homeless, or people that just need a little bit of help getting back on their feet. Typically, these leases are between 3 and 10 years, and it means that you won't have a break clause in that time. The provider will also look after things like maintenance, just making sure that in terms of general wear and tear, things are kept to a good standard. So when they hand back those keys at the end of the lease, they're actually giving it back to you in the same state that they received it. Now, clearly there are lots of benefits to renting your property to an organisation like this, but there are also some pitfalls that you really need to understand. We'll come to those a little bit later on. But first, let's talk about what kind of properties generally these social housing providers are looking for. Now, realistically, they're usually looking for a house, something between 2 and maybe 4 bedrooms. And sometimes if it's a 4-bedroom, they might even convert a living room space into a 5th bedroom. And that means that they can house more people in there. These can be terrace, semi-detached or detached properties. It doesn't really matter. And I'll be honest, I do actually have some clients as well that actually rent out flats to social housing providers too. There's plenty of different criteria that social housing providers will request, and the best thing you can do is to click the link down in the description to find the government social housing provider list, and these are the list of all the registered social housing providers in the country. You can then go and find a local housing association or social housing provider to where your properties are, get in touch with them directly and actually find out exactly what kind of properties they're after. So to summarize, some of the great benefits to this strategy are no void periods to start with, because the lease is going to be over a number of years, not just one single year like a standard AST. The maintenance will be looked after by the social housing provider if it's a good social housing provider. Some don't, so make sure you have a look on the lease to ensure this is included. And this just means that you don't also then have to pay money on a monthly basis for maintenance. You also don't need to employ the services of a property management company because the social housing provider is going to manage the tenants that are in there, because of course they are the people that are putting those people into the property. So as you can see, this is probably the closest that you're going to be able to get to a passive income strategy when it comes to property. But as I said before, there are some pitfalls or some little things that you just need to be aware of before you just go head first into this strategy. Now, I have to admit, in my capacity as the owner at Grand Union Finance, we get a lot of clients that obviously come to us with this strategy, and a lot of these pitfalls that I'm going to talk about are going to be finance related. They're going to be down to mortgages that are available if you're going to enter into this kind of lease. And I'm just going to warn you, little spoiler alert, it's not great news. It is harder to get a mortgage if you're going to look at this strategy. But just bear with me a minute, because there are some ways that we can make it work. So first and foremost, the lease length. Now, most mortgage lenders require that any property that you're going to be renting out on a buy-to-let basis is actually on a standard AST, a 1-year tenancy agreement. This is just the norm in the UK. Anything that's outside of the norm, lots of lenders get funny about, and this is a great example of that. So with these leases sometimes being up to 10 years, obviously this is going to cause a little bit of a problem for some lenders that prefer you just to rent your buy-to-let property on a standard AST. Depending on the lease length will depend on the number of lenders available to you. There are generally points at 3 years, 5 years and 10 years where we're going to start losing lenders because of the length of the lease. A couple of providers that actually aren't on that government social housing provider register that I mentioned earlier on, but are two big nationwide social housing providers, are Serco and Mears. You may well have heard these names before. Now, their standard lease is 7 plus 3 years. And what that means is the standard lease is 7 years, and there is a roll-on of an additional 3 years to take it up to 10 without really much review, essentially. Now, the bad news is that most more mainstream specialist type buy-to-let lenders will have a maximum lease length of 5 years. This can clearly be problematic, but never fear, all we need to do is ask the provider to reduce the lease down to 5 years and it will pass. So that is something that we could do. So although it's a negative, don't worry too much at the moment. Now, staying with the lease, there are some things that are going to be written in as standard a lot of the time that we also need to be aware of that lenders just won't like because it goes outside the norm, and as a result, they see it as a massive risk to them. The next one is break clause. Most of the leases that I see as drafts will have some sort of break clause in them, but they are either quite lengthy, so it might be 2 years plus, and weirdly, they seem to be in favour of the tenant rather than the landlord, i.e. the tenant, the social housing provider, can break the contract or give notice to break the contract, whereas the landlord can't. From a lender's point of view, this is a big risk. Just imagine they have to repossess the property for any reason. They are going to really struggle to kick out that tenant, i.e. the social housing provider, because there is no break clause that's in favour of the landlord. If this is the case, we have to go back to the social housing provider and make some amendments. And generally, I find that my clients are able to do that. So again, although it is an issue, there is a solution. And generally speaking, most social housing providers are pretty happy to make some amendments to their draft lease to ensure that the people that they're going to work with can get the mortgage that they need. Now, the last part about the lease that we just need to be wary of is actually the description of the ultimate tenant. And what I mean by ultimate tenant is the people that are actually going to reside in the property. You've got obviously your landlord, which is you potentially. You then got your tenant, which is the social housing provider, and your ultimate tenant are the people that are actually going to end up being in there. It is a form of subletting after all, so there are different people in there to the people that are actually going to be taking out the tenancy. Now, if it is deemed that there are going to be vulnerable tenants in that property, lenders again are going to have an issue with this. This is due to something they call reputational risk. Now, I've had many conversations with lenders over the years where I genuinely disagree with this point, and I'll tell you why in a second. But essentially what they're saying is that they are concerned that if they do need to repossess the property, it could look bad on them that they are seen to be turfing out vulnerable people onto the streets. Now, the reason why I have this argument with lenders quite a lot of the time is because I genuinely disagree with this. The standard process of repossessing a property would take 6 months plus, and in that time, the social housing provider will, of course, be able to rehouse those people into another one of their properties, so it shouldn't be an issue. In fact, it's not a reputational risk. It could potentially be genius at PR because, of course, if they can tell the world that they are actually helping house vulnerable people, that's even better. Now, another thing we just need to be wary of is the rent that you're going to be receiving. Generally speaking, the rent that you'll get will be below the market average for what you could potentially rent that property for. Now, the reason really that people are entering into this strategy is because it's more passive. It's not because you're going to earn more money. I genuinely believe that the end game for most of the investors that I work with is to have as passive an income as possible, and it's not really to do with the cash flow per property. You get that cash flow at the beginning whilst you're building your portfolio, and then you basically drop your yield and make your portfolio more passive towards the end. Then you can go and enjoy that money. Now, that's not to say that there aren't a lot of providers out there that will pay above the market, but you've got to do the rounds, you've got to speak to different providers in the area, not only to find their criteria, but actually to find out what they're going to pay you. Now, this leads me on to the final point that we just need to be wary of, and this is actually the type of property that it will be deemed to be. Now, so far we've been talking about buy-to-let properties, and to be perfectly honest with you, a lot of these properties will look like standard family homes when you're renting them to these social housing providers. However, if these properties are going to be rented on a room-by-room basis, mortgage lenders potentially will deem them to be HMOs. This then sets up a new line of potential issues because you are going to have to get an HMO product with those lenders that are happy to lend on those leases, and that means a whole new level of criteria we need to deal with. Generally speaking, lenders that lend on these leases also have in their criteria that if the property is an HMO and you're taking out an HMO product, that means that they want to see that you have some experience as a landlord. So if you're starting out for the first time buying a property and renting it on one of these leases, it could be extra difficult for you to find a lender. But the first time is never going to be the easiest time. If you're really interested in this strategy, the best thing to do is to get in, and improve as we go. Don't forget, purchase price is permanent, interest rate is temporary. So there you have it, guys, a quick snapshot of this fantastic new strategy that I think is going to keep getting bigger and bigger and bigger. If you want a portfolio that is going to be really passive, this is the strategy that I think is best suited for you. Now, before I let you go, again, please, if you haven't already subscribed to the channel, as I've mentioned before, we are trying to get to 5,000 subscribers on the channel by the end of the year. So just hitting that subscribe button will massively help towards that goal. Now, if you've enjoyed this video and you think that this property strategy might be the one for you, do make sure to use the link in the description to reach out to myself and the team at Grand Union Finance, because we are experts at helping people finance these strategies. Not only in terms of mortgages, but sometimes you might need some other kind of finance to acquire the property and make the changes needed to get them ready to let to these social housing providers. We can help you with any different type of finance that's needed, and we are experts in reading these leases and working with these types of mortgage lenders. So get in touch if you need any help. Thanks very much for watching, guys. Now, if you have enjoyed this video, I've actually got a playlist that covers every video that I've done on this social housing strategy, which you can find up here right now. But if you fancy something a little different, there's also another video being recommended to you right now. And of course, as I mentioned before, please subscribe. See you on the next video.